Hi, folks. My name is Denison Bertram. I'm co-founder and CEO of tally.xyz. Today, I'm going to talk about capital markets. Really, I wanted to talk about on-chain capital markets, but I figured that before I get there, I might as well do a Friday episode grounding us in the basics. So I thought, okay, let us start with capital. Capital markets are the systems through which long-term capital is raised. It's allocated, priced, and traded, right? Capital markets connect capital providers, which are, investors, with capital seekers, companies, governments, and projects, that sort of thing. At a high level, capital markets answer for us four questions, right? Who needs capital? Who has the capital? At what price will one transmit the capital from one place to another? And under what rules and protections? Right? They're distinct from money markets, which deal with short-term funding, things like treasury bills or commercial paper, ways that companies cover their expenses in short amounts of time. And there's kind of two markets here to think about this: primary and secondary markets. Primary markets are generally where the actual capital formation happens, right? This is where new capital is created. Right? So, for example, initial public offerings. Later, I'll talk about initial coin offerings. Follow-on equity offerings, corporate bond issuance, government bond auctions, or private placements, right? Things like VC, private equity, private debt, that sort of thing. Right? Investors' money goes basically directly to the issuer, right? So the company is looking for money, the investor's money goes directly to them, right? This is a primary market. Secondary markets are where you do the liquidity and price discovery. That's sort of like where, if you were thinking about tokens, the ICO would be the primary market, but then Uniswap would be the secondary market. And this is where existing things trade. In the traditional world, this is where existing securities trade. Like an example would be a public stock exchange or a bond trading desk or an OTC markets, right? These markets don't fund the issuer directly, but the liquidity here is still essential because without a secondary market, investors would demand a much higher return in the primary market because they don't have an opportunity, they don't have a place to sell their position or their stake, whatever they've gotten, right? So this is basically equity. So now talk a little bit about equity, right? Ownership. Equity has like ownership claims on residual cash flows. It's kind of like what you classically think of a business, right? There has some cash flow coming in and like you own a part of the business. So you have some sort of claim on that, right? It's a high risk, high return business. And generally you get voting and governance rights, right? Stockholders get to vote. They have some say in the board and thus kind of control. Right. And these instruments here are the common stock, preferred stock, and, various options and warrants, which are kind of equity derivatives. Then you have debt. And debt is basically, what it sounds like. It's a contractual obligation to repay a principal plus interest and is lower risk than equity, but mostly because it has seniority in a bankruptcy, right? So they get paid first for the shareholders, the stockholders who might not get anything once the debt was netted out. So for this, you'd think of something like corporate bonds, government bonds, and loans, notes, and sort of like asset-backed securities. Like these are, not boring, but there's the sort of kind of other thing. And then of course we have sort of like hybrid structured stuff, which combine the features of equity and debt. But basically, those are generally engineered to reallocate risk in some way, right? And I think an example of that would be convertibles, structured notes, mezzanine debt, that kind of thing. So who makes all this work? Like all the sort of like pieces that you need? Well, you have the market like infrastructure, right? So you have the issuers, which are corporations, governments, financial vehicles, things like, special purpose vehicles or trusts. And then you have intermediaries. The intermediaries might be investment banks who do the underwriting or distribution, brokers and dealers, asset managers, custodians, and clearinghouses. Then, of course, you have the venues, which are, as you would imagine, exchanges. And in this case, we're talking about centralized exchanges, right? Because we're not talking about the on-chain capital formation yet. So exchanges, the centralized exchanges, and OTC networks, whether they are, bilateral OTC networks or dealer mediated. And some, examples of this would be the New York Stock Exchange or the NASDAQ, right? And then you have regulators. And regulators are very important here because they set disclosure rules, they enforce market integrity, and most importantly is that they protect investors, right? So the example of that is obviously the U.S., the SEC, like the U.S. Securities and Exchange Commission. If you really think about capital markets, they are kind of fundamentally a kind of risk pricing machine, right? The key principles here are like the higher the risk, the higher expected return. Yeah, you definitely see that in crypto where you have some tokens that have really high rates of return, but of course they were very, very risky, right? Then you have the time value of money, and diversification and how that reduces idiosyncratic risk. And then have to think about systemic risk, which generally can't really be diversified away, right? The pricing inputs here are cash flow expectations. What is this company going to make? How much money they're going to make? How successful they are? The discount rates, the volatility, and correlation with broader markets. I think the sort of canonical models that you hear people sort of like talk about when you sort of talk about these things, or overhear people talk about these things like the discounted cash flow model or capital asset pricing model or yield curves and credit spreads. These type of things that end up being a little bit of a mouthful, but are these type of things, right? Then when we talk about I guess like the next point is liquidity and market efficiency, right? So liquidity, and this is really important. It's when in crypto we talk about liquidity all the time, right? Liquidity is basically your ability to buy or sell something without moving the price of it, right? And this depends on the depth, the breadth, you know, and immediacy. And, when we think about like crypto, you have very liquid markets, things like ETH to USDC or USDC to USDT. And then you have illiquid markets, which are, in the traditional world, things like private equity, venture capital, real assets, right? It's hard to get out of a private company. It's hard to sell, land, for example, right? Whereas in the traditional world, a highly liquid market might be like large cap equities. Tesla is an extremely liquid market, sovereign bonds, right? And then, of course, in crypto, you have low liquidity markets, which could be anything. And those are just tokens where, small sales move the price enormously. So in practice, when talking about market efficiency, there's kind of like a lot of ways to think about this. You could think about like the price reflects all information, maybe prices reflect past information, or prices reflect public information. But I think a useful way to think about this is that in practice, markets are really just efficient enough to be hard to beat. But inefficiencies do exist. And, you certainly see that in crypto, but you see that in the traditional markets as well, right? And you see this in things like complex instruments, regulatory gray zones where, not everyone who might participate in a market is participating, and especially during stress events, right? I think it's useful to compare these two things, like compare capital markets with banking for a moment, right? Like banks are balance sheet based credit. They create credit. They're very heavily like relationship driven, and they're heavily intermediated. While capital markets are market based, right? And rather than creating credit, they do allocating capital. They're price driven, and they aren't these sort of like relationship heavily intermediated things. They're disintermediating. They're reaching a lot of different people, right? Modern finance increasingly shifts risks from banks to markets, right? So why capital markets matter is I think systemically you think of capital markets as funding innovation and infrastructure, right? Most good things that you have come from capital markets that funded innovation that got us that, right? It enables us to share risk across society, right? Many, many different investors participate in something like Tesla or Apple, right? They encourage disciplined management through pricing. The price sort of like reflects how people think are operating a company. And they also do things like transmit monetary policy and amplify shocks when, things are mispriced or over leveraged. For example, in the 2008 and 2020 crises, these are often called capital market like plumbing failures, not just like bad assets, right? It's sort of like a failure of the system. So, thinking about like current structural shifts here, you have passive investing dominance. That's kind of a popular thing. Private markets are overtaking public markets, which has been an interesting shift. You have tokenization and on-chain settlement, which is where I really come in and really care about. Regulatory arbitrage between jurisdictions, which is something I think like the last maybe couple cycles in crypto had to deal with. And of course, like AI participation in the markets as well, right? It's sort of like today, it's a little bit less of an issue of how like it's not like we're talking about like whether or not capital markets actually allocate capital, but really more about like who's controlling the rails of crypto, right? And rails of capital markets. And I think what is going to be really interesting, I'll talk about this next time. I wanted to not make this too long. I just wanted to make this a real primer, is how crypto is really disintermediating many of these things and making capital markets more efficient, wider, broader. Certainly, like when we created Tally, one of the ideas was to drive the cost of capital formation to zero and do the incorporation in software rather than jurisdictions. And that continues to really excite me. I think this is super exciting. So I wanted to offer this up as a little bit of a tidbit. Maybe you're driving your car, maybe you're, on the subway and you're just sort of listening to this. I'm kind of like enjoying myself doing these videos. I didn't really expect I would enjoy doing these videos as much as I am. And it's kind of neat to talk through topics that I don't necessarily think about every day, but it's really nice to sort of like refresh on and share and talk about, especially when you get a chance to see how it like ties directly back into like what you're working on in a day to day. So this has been my capital markets episode. It's kind of like DeFi Finance 101 from Tally. But that's it from today. So next time I'll go through on-chain capital markets and get deep on how the crypto rails are remaking capital markets with tools like Tally that we build. So until then, see you next time.